There's a saying, don't run after the money, instead, be a money magnet. In other words, letting money grow your money is the key to building wealth. One of the best methods to yield tons of money is through investing. If you are looking for an investment strategy that will give you financial freedom, you've come to the right place. Watch to the end to learn how to start dividend investing and use it as a long-term growth strategy. You've likely heard about dividend investing as a means to acquire financial independence. You just need to invest in a share of a company that rewards you with dividends. Simple, right? Dividend growth investing is one of the best long-term investments you can make as long as you make wise and intelligent choices. First of all, we need to understand the basics. In financial terms, a stock is a share in the equity of a company. This amounts to a part ownership of a company. Owning stock in a company means owning a part of the company's assets and profits. These shares are traded on the stock exchange market. Stocks can be purchased through online broker apps like Robinhood and Webull. See the links in the description for more information on these apps. Dividends are actually a great source of passive income. A dividend is the sum of money you are paid from the profits of the company you own a share of. When you buy a share from a publicly traded company, this gives you ownership of that company in accordance to the number of shares you own. Buying stock in their company means you purchase the right to gain from the payouts from the company's profits. The amount of money you gain from the company will depend on the number of shares you own in the company. Dividends may be in a form of additional stock or cash. A dividend would be a good long-term investment option if you choose the right company to invest in. It will help you maintain financial freedom for a long period of time to come. Dividend growth investing involves buying a stock that pays you a dividend, which will reward you over time as long as you have the equity in that company. If you do your research and make the right choice in choosing the right company, you can escape the rat race. Imagine yourself vacationing on the beaches of San Diego, relaxing and waiting for your dividends to just arrive in your bank account. This type of investment is a smart money tactic that will give you the experience you are waiting for. You just have to plan wisely to ensure a stream of income from the stock that the company will give you for that cash flow. Just like any other worthwhile endeavor, getting into dividend growth investing, you have to acquire the proper knowledge. Before deciding where to put their money, investors will start to make an investment portfolio or a dividend reinvestment plan, or DRIP, first. They tend to look for companies with a very good track record of paying increasing dividends year over year. They would look for companies that have been growing financially and in size, could pay their expenses, and maintain a continuous cash flow. These companies should be increasing their dividend payments in parallel to their steady growth. Dividend growth investing will lead to a substantial portfolio over time. A study shows that an increase of over 80% is possible when dividends are reinvested over a period of 50 years. This means that earnings become greater and greater as your portfolio grows and as returns increase. Your initial investment may look small, but reinvested dividends will make your nest egg quite significant. Dividend investors focus on two main investing strategies: owning stocks from companies with high dividend yields or from a high dividend growth rate. Both serve different roles in different kinds of portfolios. With high dividend yields, this strategy focuses on slow-growing companies that have a large cash flow. These companies fund large dividend payments and produce a rapid increase in income for their investors. It is necessary for the investors to understand and to know the absolute reason for the high dividend yield of the company and to investigate if it is stable. With high dividend growth rates, this strategy focuses on companies that are growing quickly over time. It narrows down on companies that are continuously increasing their dividends. The most significant objective in dividend growth investing is the growth in income per share. Growth in income per share enables the company dividends to grow over time in a more stable way. This strategy aims to increase the dividend over the long term. Generally, dividend investors will choose one strategy at a time, depending on their financial goals. The choice will solely depend if they want a short-term or long-term investment. With either strategy, you will want to look for companies that raise their dividends yearly. You will want to diversify your portfolio across different sectors to help balance the ups and downs in the different industries. Most importantly, you want to make sure that the dividend growth is sponsored by profits and not debts or loans. As a better wealth builder with a good money mindset, you probably have a lot of ideas running through your head. One question might be how to start this dividend growth investment. As an investor, the basic and most essential thing to you is gaining more income with your chosen investments. To get started with dividend growth investing, you should do the following. Number 1, select your dividend strategy. You need to decide on the appropriate dividend strategy that is suitable to the financial target you want to achieve, whether it is from high dividend yields or a high dividend growth rate. Number 2, thoroughly check the company's background and data. Never forget that you must choose a well-established company with a good dividend standing, one that is focused to raise their dividends yearly and unlikely to reduce or stop their dividend over time. Number 3, select a method of investment. Choose if you want to buy dividend-paying stocks directly or buy an exchange-traded fund, or ETF. Buying dividend stocks can be a good way for investors who are looking for income-generating investment in their dividend reinvestment plan. This method gives investors a low-risk investment since you are buying a share directly from the company that meets your standard. While an ETF is a type of investment that tracks a commodity or asset class which can be purchased or sold on a stock exchange similar to a regular stock. This type of fund is managed by a broker over many types of stocks and gives you safety in the diversity of the companies in the fund. Check out our videos where we go into more detail on the risks and benefits between stocks and ETFs. Everyone has doubts when talking about their money or their assets. It is healthy to have questions before jumping into a decision. In the stock market, we all know that everything is not 100%. It is subject to the fluctuation of the market and other economic conditions. Through the years, dividend growth investing has been proven to be a good income-producing long-term investment. Still, it is a good reminder that there are some companies that failed in this. The best way to lessen the risk of this investment strategy is to be cautious and research the companies that give high dividend yields. Look for companies that have an average dividend yield of 5%. Also, look for companies that have been paying and increasing their dividends for at least the last 25 years. Different investors have different ways of managing their own investments. There are investors that are confident in their own way of managing their portfolio in the stock traders world, while some would prefer to have a broker or a financial advisor and profit from their knowledge of investments. No matter which decision you make, the dividend growth strategy is a good long-term investment. It is simple and easy to comprehend and will provide growing income each and every year. Focusing on long-term investing and having diverse investments will help stabilize your portfolio through all the market volatility and the abrupt changes in the stock market. That's it for today's video. We hope we have given you a little more information with your investment choices. Let us know your thoughts in the comments section below. Don't forget to like and subscribe so you don't miss out on future videos like this one. Check out this top video from our channel and I'll see you in the next one.